Welcome to MogulCast, where we uncover the stories behind the world's greatest business empires. Let's get into today's story.
In 2 days, Bill Hwang lost $20 billion of his own fortune, one of the fastest personal wealth wipeouts in Wall Street history. Just weeks earlier, his family office, Archegos Capital, controlled positions worth over $36 billion, built quietly, invisibly, without a single public disclosure. Then, it all came apart. Banks scrambled, stocks crashed, and the man behind it all walked into a story that would end, years later, in a federal prison sentence. This is the full story, and it is worse than you think. Before Archegos, there was Tiger Asia Management. Bill Hwang's earlier fund, one of the so-called Tiger Cub funds, descended from the legendary Tiger management lineage. But Tiger Asia's story did not end well. In 2012, the fund pleaded guilty to insider trading of Chinese bank stocks and paid a $44 million fine. In 2014, Hong Kong regulators banned Hwang from trading in the territory for 4 years. For most fund managers, that would be the end. For Bill Hwang, it was only the beginning. We will come back to one specific decision. It is the key to everything. In 2013, Hwang started over. He created Archegos Capital Management, Greek for leader, structured not as a hedge fund open to outside investors, but as a family office managing his own personal fortune. That distinction mattered enormously because family offices face far lighter regulatory scrutiny than hedge funds do. By 2020, Archegos was managing $10 billion. No public filings, no outside investors demanding transparency, just one man and a small team, quietly assembling one of the most concentrated portfolios on Wall Street. From that $10 billion dice, Archegos exploded outward. Hwang didn't buy stocks the traditional way. He used total return swaps, contracts where banks held the actual shares, and Archegos simply bet on the price moving up. That structure let him build enormous stakes in companies like Viacom CBs, Baidu, Vipshop, and Farfetch, all without ever appearing on a public filing as the owner. On paper, it looked like extraordinary skill. In reality, it was extraordinary leverage most of Wall Street couldn't see. By March 2021, Archegos reportedly controlled positions worth over $36 billion, built almost entirely on borrowed money and swap contracts spread across multiple prime brokers. Credit Suisse, Nomura, Goldman Sachs, Morgan Stanley. Each bank saw only its own slice of Hwang's exposure, never the full picture. Every bank thought it was managing its own risk responsibly. None of them saw a family office quietly assembling one of the most dangerous concentrated bets in modern Wall Street history. But not everyone was celebrating. Here's how the structure actually worked. Instead of buying Viacom CB stock directly, Archegos entered a swap contract with a bank. The bank bought and held the shares. Archegos never appeared as the owner, and never had to disclose its position under securities law. But here is what the media completely got wrong about this. This wasn't one reckless bank enabling one reckless trader. It was several of the world's most sophisticated banks, simultaneously and independently, each unaware the others were extending Hwang the exact same enormous exposure. That blind spot was the entire strategy. Total return swaps let Archegos avoid the disclosure thresholds that would normally force a large shareholder into public view. No filing, no red flag, just quiet accumulation, bank by bank, position by position. It worked spectacularly until the stocks underneath those swaps stopped going up. And when concentrated positions that large start falling instead of rising, the same leverage that built the fortune becomes the exact mechanism that destroys it. Unraveling began with a margin call. Banks demanding more collateral as Archegos concentrated positions in Viacom CBs, Baidu, VEAECBs, by diary, VOEI started losing value. Hwang didn't have it. Not for Credit Suisse. Not for Nomura. Not for Goldman Sachs. Not for Morgan Stanley. Every bank offering Archegos prime brokerage services was suddenly staring at the same terrifying question. How much exposure do we actually have to one man's family office? And why did we never know the others were exposed too? On March 26, 2021, Archegos failed to meet its margin calls. Banks stopped waiting for more collateral. They began liquidating Hwang's positions themselves, dumping billions of dollars of stock onto the market in emergency block trades. CB's shares plunged 27% in a single session, with other Archegos holdings falling sharply too, as the same underlying collateral was sold off by multiple banks racing to exit before the next bank made the crash even worse. According to Bloomberg, Hwang personally lost $20 billion in just 2 days. The Wall Street Journal put the toll at $8 billion in 10 days. Either way, it remains one of the fastest, largest personal wealth wipeouts in Wall Street history, and analysts would later compare the fallout to the meltdown caused by long-term capital management. And if you have made it this far, you already understand something most analysts completely missed. No single bank ever saw the full danger because no single bank was ever meant to. Collapse rippled far beyond Hwang himself. The global banks that had extended Archegos its swap-based leverage absorbed steep losses when they were forced to unwind those positions at the worst possible moment. Regulators around the world took notice. The episode became one of the starkest illustrations of how a single family office, operating almost entirely outside public disclosure requirements, could quietly build risk large enough to shake institutions supposedly far too sophisticated to be blindsided. In the years that followed, banks tightened how they handle swap-based leverage in family office relationships, and regulators pushed for greater transparency around exactly the kind of derivative structure Archegos had used to stay invisible. Bill Hwang faced federal charges of fraud and racketeering. In November 2024, years after that catastrophic week in March 2021, he was sentenced to 18 years in prison. Remember that decision we mentioned at the start? The decision to keep building an empire on total return swaps after already being banned from trading in Hong Kong, after already paying millions in fines for insider trading. Here's what it actually cost. Not just $20 in personal wealth, erased in 2 days, but 18 years of Bill Hwang's life, sentenced away in a federal courtroom for fraud and racketeering. Let's put the numbers together. Over $36 billion in positions at Archegos peak. $20 billion in personal losses in just 2 days, according to Bloomberg, or $8 billion in 10 days, according to the Wall Street Journal. A $44 million fine from Hwang's earlier fund, Tiger Asia, for insider trading in 2012, a 4-year trading ban in Hong Kong starting in 2014, and finally, in November 2024, 18 years in federal prison. Here's the insight that makes this story different from a normal market crash. Archegos wasn't publicly traded, wasn't a hedge fund raising outside money, and technically wasn't breaking disclosure law by using swaps the way it did. The real lesson isn't just that Bill Hwang broke the rules. It's that the rules allowed a previously sanctioned trader to quietly assemble billions in hidden leverage across banks that never talked to each other. The danger wasn't fraud alone. It was invisibility. Bill Hwang built and lost one of the fastest fortunes in Wall Street history, banned once, fined once, and ultimately sentenced to 18 years for fraud and racketeering. If you want to understand how this pattern repeats across every major business collapse, the next video covers a story with disturbing parallels. That one is next.
That's the story for today on MogulCast. If you found this valuable, subscribe and hit the bell. A new empire story drops every single weekday. See you tomorrow.